So if you want a sensible view on where fixed mortgage rates might go over the next 3 to 5 years, don't stare at the bank base rate. Look at SONIA futures and swaps. Today I'm going to show you how the mortgage market's crystal ball actually works and what it can mean to you and your next fixed rate mortgage. So what is SONIA? SONIA is the Sterling Overnight Index Average. It's the rate that banks pay to borrow overnight, based on real transactions and administered by the Bank of England. Futures on SONIA and the related swaps built from SONIA allow us to read the market's implied path for short-term rates over time. So why are SONIA futures useful? Well, the Bank of England's own forecasts are conditioned on the market implied path of rates derived from SONIA. In the August 2025 Monetary Policy Report, that path falls to 3.5% by quarter 2 of 2026, and then edges back up towards 3.7% by quarter 2 of 2028. And that's literally the curve that the Bank of England used in its projections. So when we talk about market expectations, we're not guessing. We're reading prices that professional investors are trading every day. And here's how it affects UK mortgage rates. UK fixed mortgage rates are largely set off SONIA swap rates, 2-year and 5-year. Mortgage lenders hedge fixed price loans with swaps. So the swap rate is the lender's wholesale cost for that fixed period. So your fixed rate mortgage deal is the swap rate plus the lender's margin. So capital costs, credit risk, competition and fees. And that's why sometimes you see fixed rate mortgage prices moving when the Bank of England base rate is stable. It means the swap rates have changed. And we've seen this in practice when swap rates fell earlier this year. Some of them were sub 4% on deals with low loan to value. So what's the latest path suggesting, I hear you ask? So for a starting point, the bank base rate's 4% as of September 2025. And the Bank of England signalled a cautious data-driven approach. Now the market implied path dips to 3.5% by mid-2026. Trending around the mid-3s and nudging up to 3.7% by mid-2028. Now this isn't a Bank of England promise, it's just the curve that the Bank of England used. So if you want to map that onto mortgages, if 2 and 5 year SONIA swaps broadly track the path over time, then fixed rate mortgage pricing is going to broadly follow that path with a bit of margin on top. So to illustrate this, if the 5-year swap is around the mid-3s, adding a typical all-in margin could point to mid-4% for strong low LTV cases, give or take competition fees and risk appetite. Conversely, if inflation proves a bit stickier and the curve reprices a bit higher, then swaps and fixed rate deals can lift very quickly. We've all seen mortgage products being very quickly withdrawn or repriced. So why should we trust this measure? Well, for one, it's what the real money is betting on, futures and swaps. And the Bank of England explicitly conditions its projections on the market implied path. So by following this measure, you're directly aligned with the reference curve that policymakers themselves are watching. So what are the risks and scenarios? If disinflation stays on track, and with a cooling labour market, the Bank of England expects the consumer price index to ease back down to around 2%, sometime around spring 2027, which supports a gentle drift down in the curve. Then there's persistent risk. Some of the Monetary Policy Committee members are warning that inflation could be stickier than we think. That's going to keep the curve higher and delay cheaper fixes. And then of course there's possible macro and news shocks. Global tariffs, energy prices and geopolitics can swing swaps fast, and product rates can react within days. Recent moves from some lenders underline that sensitivity. So what should you actually be doing? Well, if you're remortgaging within the next 6 months, consider securing a rate early. Talk to a broker and keep your eye on the swap rates. Even once you've locked in a rate, it can usually be repriced later if the market moves. FCA research shows us that many borrowers currently pay more than they need to because they fail to switch. And if you're looking to choose a term length, then a 5-year fix dampens reinvestment risk if rates chop around. And whilst a 2-year fix can be cheaper up front, it exposes you to whatever the rates might be in 2027. So you really need to pick a term that aligns with your income stability, future plans and your risk tolerance. And of course, if you're on a tracker rate, then you're directly exposed to bank base rate moves. The market path suggests general decline over time, but it's not guaranteed. So if you want to keep an eye on the market, hit subscribe or follow for my weekly swap rate and mortgage market updates, where we'll be taking a regular look at what the Bank of England's doing, what the swap rates are doing, and what it really means for mortgage products. And if you want to get in touch, then hit my link tree in the bio. And as always, this is 100% informational, not advice. If you want real advice, then get in touch and speak to a broker like me.